When you think about retirement, you probably picture vacations, time pursuing hobbies, or being close to family. But there's one thing that a lot of people overlook, and that's taxes. The state you choose can make or break your retirement budget. Income taxes, sales tax, property tax, estate tax, even hidden fees can quietly drain tens of thousands of dollars every year. In fact, taxes could be the difference between living comfortably or running out of money too soon. And it's not just the income tax. Many people stop there and miss the other tax traps that matter just as much. In this video, I'll break down the best states to retire in if you want to keep more of your hard-earned money. Plus, I'll share with you which taxes you should focus on depending on your situation. So let's run through the different types of taxes, starting with the top state income tax rates. First off, 8 states don't have any income taxes at all or capital gains taxes. That would be Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, and Wyoming. Washington usually gets lumped in here too, but it does tax long-term capital gains. For states that do have income tax, top marginal rates range from 2.5% all the way up to 13.3% in California. And that's just the headline rate. Some states like California and Massachusetts also place extra taxes for things like disability or paid family leave. California, for example, adds about 1.1% for state disability insurance. But here's the kicker. Income taxes alone isn't the whole story for retirement. Some states tax earned income from working, but they don't touch Social Security or retirement account withdrawals. That means the actual hit could be way less than the top rate makes you think it is. Speaking of Social Security, only 9 states tax those benefits in 2025. That would be Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. A quick note on West Virginia. It's phasing this out, and the tax is reportedly going to end in 2026. There are 13 states that do not tax pension income or 401k or IRA withdrawals. And that could be a huge benefit if you have built up a large retirement account or you're drawing on a pension. That group includes the 8 states with no income tax, plus Illinois, Iowa, Mississippi, Pennsylvania, and Washington. Now, 2 states are a little different, Alabama and Hawaii. They don't tax pension income, but they do tax 401k and IRA withdrawals. So as you can see, it's not just about which states have the lowest income tax overall. What really matters is what type of income they decide to tax and how that lines up with the way you'll be funding your retirement. Now, when it comes to capital gains taxes, the story is similar. The 8 no income tax states are in this group, and Missouri just joined them, eliminating capital gains taxes starting in January of 2025. Now, if a state isn't taxing your income, trust me, they're getting their money someplace else. And depending on how you live, those hidden taxes can hit you pretty hard. So the real question isn't just, will my state tax my income? It's what's the total tax bill going to look like? So let's break down the other 4 taxes that you'll want to keep in mind. First, I'd like to take a quick moment to say, I hope you hit the like button. Leave some comments below after you get done watching this video. It really does help the algorithm, and I'd really appreciate it. Okay, first let's talk about sales tax. If a couple spends around $40,000 a year on purchases that are subject to sales tax, the extra cost could range to almost $4,000 per year, depending on where you live. In some states, that can really eat into your budget. 5 states have an average sales tax rate above 9%. That would be Louisiana, Tennessee, Arkansas, Washington, and Alabama. Take Tennessee, for example. It doesn't tax your income, but the average sales tax rate is 9.56%. About 60% of the state's tax revenue comes from sales tax, and even groceries get taxed, although at a slightly lower rate. The state sales tax is 7%, but local governments can add up to another 2.75%, which is how the average gets so high. On the flip side, 4 states, Delaware, Montana, New Hampshire, and Oregon, have no sales tax at all. Alaska doesn't tax at the state level, but local taxes average about 1.8%. And it's not just about the everyday spending. Think about bigger purchases in retirement. Maybe you want to start a classic car collection, or you're simply just replacing vehicles. On a $50,000 auto, you could be paying an extra $4,000 to $4,500 in sales tax depending on where you live. Now, let's move on to property taxes. They can be an important yearly expense for homeowners. According to the Census Bureau, the average American pays about $2,969 a year in property taxes for their home, but that number can swing a lot depending on where you live. A couple of things to keep in mind. Property taxes are set locally, so the rates you see at the state level are really just averages. Within a single state, the actual rate can look very different from county to county. And since the tax is applied to the value of the property, home prices play a huge role also, which means a modest tax rate in a high-cost area can still lead to a big bill. For example, Hawaii has the lowest property tax rate, followed by Alabama, but the median home in Hawaii is just over $800,000 compared to less than $200,000 in Alabama. That means the average property tax bill in Hawaii is actually almost 3 times higher. On the other end, the states with the highest average property tax rates are New Jersey, Illinois, Connecticut, New Hampshire, and Vermont. When you factor in both the tax rate and the home prices, the 8 states with the lowest property taxes are Alabama, West Virginia, Arkansas, Louisiana, Mississippi, South Carolina, Tennessee, and Kentucky. On the flip side, the 8 worst states in terms of total property taxes are New Jersey, Connecticut, New Hampshire, New York, Massachusetts, Illinois, Vermont, and California. And these states also tend to be near the top in terms of overall rent as well. Another thing to consider if you hope to leave an estate to loved ones is whether the state has an inheritance or estate taxes. Here's the difference. Estate taxes come out of the estate before anyone gets it, while inheritance taxes are paid by the person receiving it. Most people won't be hit with any federal estate tax. Starting in 2026, the exemption is $15 million for individuals and $30 million for couples. But at the state level, things can matter. 5 states, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania, have inheritance taxes, which can be as high as 16%. Meanwhile, 12 states, plus the District of Columbia, have estate taxes. Those states are Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington. Each state has its own rules. Take Oregon, for example. Estates over $1 million are taxed, starting at 10% and climbing all the way to 16%. So if your estate is $3 million there, expect estate taxes to be about $205,000. Definitely something to keep in mind when planning. For people with a larger net worth and hoping to leave a sizable amount to the next generation, this type of tax might be an important consideration. So that's a look at the big taxes you'll want to think about in retirement. Income taxes, sales taxes, property taxes, and even estate and inheritance taxes. Of course, There are plenty of other taxes you'll be paying, like excise taxes built in the price of products, such as gasoline. Some states add as little as 10 cents a gallon, while others tack on almost 60 cents. Vehicle registration fees can also vary widely from state to state. But this video covered the main taxes that usually matter most. The big takeaway is this: it's not just one tax that matters, it's the overall total picture. Choosing where to retire, how to structure your finances can make a huge difference in what you actually get to keep. With that in mind, let's look at the best and worst states for retirees. One study ranked the most tax-friendly states based on factors like no state income tax, no or a significant reduction on retirement income, and favorable sales, property, estate, and inheritance tax rates. And 7 states came out on top. Those would be Alaska, Florida, Georgia, Mississippi, Nevada, South Dakota, and Wyoming. 7 states also came out as the least tax-friendly states for retirees. That would be California, Connecticut, Maine, Minnesota, Nebraska, Rhode Island, and Vermont. Other states fall somewhere in between, as you can see from this list. I'll leave a link to the maps and rankings used in this video in the description below if you're interested. But these rankings might not reflect your unique situation. You'll need to decide what matters to you most, whether that's taxes on retirement income or maybe estate or inheritance taxes. For example, if you're planning to do large amounts of Roth conversions over the next few years, then the state income tax rate could be especially important during that time. Every situation is unique, but I hope this video gave you some useful information to think about. Now, of course, taxes aren't the only factor when choosing a place to retire. Whether being close to family or whether you'd just like to be near the ocean or the mountains might all matter too. But taxes do play a big role. They can have a huge impact on how much of your retirement income you actually get to keep and enjoy. If you found this video helpful, please give it a like, share it with other people maybe planning for retirement. And thank you for watching.